Hi, our group consisting of myself, Amy, Matt, and Kathleen is going to talk to you today about accounting and data analytics. And are we ready for the future? To start, we're going to talk about uses of data analytics, the differences and types of supervised and unsupervised models, and the future of decision analysis.
Uses of data analytics. Some of the uses of data analytics are to analyze data that could be over a period of time, spread out between years, months, or even days. Data analytics can also help find trends in data. These trends could help predict future earnings, or maybe even pinpoint the source of what started a trend in the data. Data can also be organized into different categories, whether it is to see how different sections of a company are performing or what items are most popular for a retail store. Organizing data can help to locate, identify, and retrieve important parts of data more efficiently. Companies that use mass analytics are Deloitte, Ernst & Young, PricewaterhouseCoopers, and KPMG. KPMG uses IBM's Watson to analyze data and detect anomalies. The AI can data mine in a client's accounting and operation systems and then use those findings to send to auditors. This is a much faster way to go through data and is less labor intensive for us humans. The use of AI. AI can data mine in a client's accounting and operation systems for auditors. This could highlight high risks of misrepresentation of a company's financials. The tax department can also use the AI to interpret new tax law changes the IRS may update each year. This could highlight new code and case law changes and then identify how clients would be affected by the changes. AI can also be used for statistical analysis to understand how a company may operate. This analysis would be helpful to predict future growth with trends or future growth for a business as well as shortcomings of the business. AI can also find duplicate transactions as well as missing data values faster than a human can. The duplicate transactions and missing data values could be an aspect of fraud or be a misinput by human that could lead to fraud. The trends used by AI could be used to detect outliers in a data set and would be something for a human to further look into. AI is also better and faster at organizing data than a human. By organizing data, you get a much better visual of data in specific groups, which is easier to look at. In an interview with James Mullen, a finance executive at Yelp, hosted by Neil Amato, James describes how technology has been a huge business transformation. He says, finance needs to have tools at our disposal to better help make decisions around how we create value, and technology really underpins that. It can help record what is going on in the business and record our financial results to a decision about where the business is going, forecasting, scenario planning, insights, and analytics.
There are two major categories of data models that are used within accounting and business analytics. They are supervised and unsupervised models. The differentiating factor between each of these is that supervised uses labeled data sets and unsupervised does not. So if you look at the example that's given here, a supervised model, and the input data, it's saying that these things are apples, and then it's predicting whether data that's applied to it is an apple as well, while unsupervised learning is taking a massive data set and then putting it into specific categories that aren't necessarily labeled. So the first one being unsupervised models. That's where we're taking the unlabeled data and we're trying to identify similarities or dissimilarities, and we're possibly trying to create some associations between the data. So in an unsupervised model, since there's no labels, the goal there is to learn from the data itself to attempt to find the pattern. So some subcategories of these are clustering, association, and dimensionality. And one that's of particular importance that's used in this kind of data modeling is a thing called Benford's Law. And that's if you're taking a group of data and you're looking at the leading digit, you would see that it would create a right-skewed histogram pattern. So you can compare data sets against this expected outcome of Benford laws. Auditors use this many times to look for misleading data. So one example of how Benford's law is used in fraud accounting is there's a study that was done that showed if a person's hand position, they were right-handed, was placed on a keypad to create numbers randomly, that they would dominantly type 4, 5s, and 7s just based on that placement, and it would cause a distinctly different curve than Benford's. So what someone who is in fraud auditing or fraud accounting could do could compare the first digit of a large set of numbers, be that invoice numbers or inventory count numbers, and they could compare them to Benford's law to see if it followed the same pattern or shape, if it was a convex curve versus that right-skewed histogram pattern as an example. Another tool that's used very regularly, this is what anyone and everyone in accounting and business uses there, are Excel tools, including pivot tables as an example. So in this example, there's a data set. It's been summarized via pivot table, and then a pivot chart sits on top of it. This is something that's regularly used to really group together large sets of data. So the other type of model is a supervised model, and a supervised model has a set of data that's clearly defined and labeled. The goal in a supervised model is to take that data's input and output information to try to deduce some kind of feature or vector. So examples of this kind of modeling include logistic regression or linear regression. It also goes a step further by clustering or predicting the outcome based on inputs and then creating classifications from those inputs. So this is something that's widely used in machine learning under a name called CART analysis. And what they do that for is to create a decision tree, because there's binary choices that can be made at each point based on variables and then split points. So this is something that's used much more commonly within machine learning.
There are many ways the accounting profession can use data analytics, and we predict the expansion of current uses and new ones in the years ahead. Accounting for revenue, expenses, and profits are the measurement of how a company is performing. What if an accountant could enter a few pieces of data from a financial statement into an established model and accurately predict future revenues, expenses, and profitability? What if an accountant could quickly search for anomalies and uncover fraud? Let's take a closer look. How can data science help accountants? Accountants might wish to test internal controls and use data sets to look for duplications or errors. Some examples of internal data sets that accountants may want to review include invoices, purchase orders, payroll, commissions, bonuses, vendors, etc. Analyzing these data sets may uncover inconsistencies and areas of concern that need further review by management. Purchase order numbers issued out of sequence, invalid address listings for vendors, unauthorized payroll changes, and missing checks are just a few of the very practical applications that, with the use of data science, can save time for accountants. While data analytics can benefit accountants with efficiency and more insightful information, there are areas of concern that need to be considered. Data analysis requires the right pieces of information to be included in a data set. Excluding data, intentionally or not, or including incorrect data, can dramatically influence the outcome of the data being analyzed. Poor conclusions can be reached, and there may be relationships or patterns that are overlooked. In addition, information changes rapidly, and the data set used may need to be updated or maintained just to stay relevant. Something that's occurring this month may be obsolete by next month. Closely evaluating the time it takes to update the data must be balanced carefully with the value of the analysis. There is a lack of data science experts in companies, and the security regarding confidential information is a concern. Ideally, a data science expert understands the business they are analyzing and is also able to help focus management into looking for answers for a concern or specific problem. Privacy of information and keeping it private while analyzing it may be difficult. To study the information, more people must have access to the data, or they can't complete their work. How can data help auditors? Auditing is an attempt for assurance that financial statements and supporting materials are presented accurately and fairly. Auditors may decide they want to focus on descriptive analytics when performing an audit so that they can find data that sticks out, that's an outlier, or some kind of an exception in a process. By closely reviewing these data points, an auditor can make selections for further review that encompass items that don't follow the rest of the data set. This process can assist the auditor in making a detailed review of unusual items or help them pinpoint the reasons why exceptions occurred. By assisting auditors in this fashion, the hope is that less time and money could be spent on the audit engagement, but still result in a high confidence adequate material was reviewed. The U.S. government is a mammoth organization and the nation's largest employer. There are strict rules and guidelines when doing business with and working for the government. There are many governmental data sets and a lot of information that is made available to the general public. As there is so much data available, government accountants may decide to extract information from data sets to find information they want to review specifically. When they create a data set with a specific purpose in mind, they can look for patterns, groups of data, and relationships in the data set. This can aid them and shorten the time it takes for them to do their analysis and to do their jobs. Consider if we could data mine and review all the data available to us rather than collecting a small sample to review. This would be an incredible opportunity to complete a more thorough review of the information available rather than looking at just a small sample. Consider if we could dramatically reduce fraud, find inefficiencies in production, and measure performance to aid in making more educated and informed decisions. Consider if we can aid clients by helping them predict outcomes and patterns and aid in visual presentations to better understand the information. All of these can be done using data science tools. People have a thirst for information to gain advantage and to assist them in making better informed decisions. Many believe that advantage can be found in a review and analysis of large quantities of data distilled down into a few consumable bytes. Data analytics models are not infallible, but they can be a resource and provide meaningful trends and insights to various stakeholders in an organization, including the accounting and finance arms. Data analytics will not replace human judgment, which is a necessary component in the accounting profession.
So for our data analysis, we selected U.S. chronic disease indicators from data.gov. We used an unsupervised model and then created analytics in Excel with pivot tables and charts and some regression analysis So the first thing that we did was looked at the reduction in diagnosis of obesity and overweight people in 2022, but there was an increase in the number of deaths. Of course, that was more than likely COVID related, but we did some additional breakout to see that there were increases across all genders and races. New Hampshire was the single state where there was little to no increase in the mortality rate for that year, but further digging in, we could see that New Hampshire didn't really have a decrease. It was that they failed to report cancer deaths. This really showed to us how quickly and easily data models could be used to parse down findings from over 1 million records. This data set was so large that it used the full everything that Excel was capable of and more. In addition to that, you could do really quick things like regression analysis to see that there was a correlation between obesity and overweight and the incidence of diabetes. You could map other things like life expectancy specific to geographic areas. Very quick and easy to do a full teardown on this huge amount of data.